Hello and welcome to traders and investors, and I'm glad to present you the daily market review prepared by analysts and experts from fx.co portal. Here we go. And we're starting with euro-dollar pair with Din Lao.
The EURUSD pair continued to move higher on Friday, and by the end of the session reached 127% Fibonacci correction level at 1.1867, based on the newly applied Fibonacci grid. A rejection from the 1867 would favor the US dollar and could trigger a pullback toward the 1802-1805 support zone. A sustained break and consolidation above 1867 would increase the probability of further upside toward the next Fibonacci extension at 161%, 1.1945. The wave structure on the hourly chart remains simple and clear. The most recent completed bearish wave failed to break the low of the previous wave, while the latest bullish wave exceeded the prior high. As a result, the trend remains bullish. On the 4-hour chart, the bear continues its upward move and has closed above the 76% Fibonacci level at 1.1813. This opens the door for further growth toward the 100% Fibonacci level at 1918. A move back below 1813 would favor the US dollar and could lead to a decline toward the 61% correction level at 1.1748. At this stage, no development divergences are observed across the indicators. Over the most recent reporting week, professional traders closed 8,357 long contracts and opened 12,604 shorts contracts. Despite this shift, sentiment with the non-commercial group remains bullish, largely driven by Donald Trump and his policies, and continues to strengthen over time. The total number of long contracts held by speculators now stands at 275,000, while short positions amount to 163,000. This represents nearly a 2-to-1 advantage in favor of bulls. Donald Trump has sharply escalated tensions around Greenland, pushing uncertainty to extreme levels. Markets responded by moving away from the US dollar, which is increasingly viewed as a risk-sensitive currency with unclear economic prospects. On Friday, the US dollar had room for a corrective rebound, but instead it sold off broadly across the market. This week, traders are likely to shift their focus on the Federal Reserve meeting, which concludes on Wednesday evening, January 28. According to the majority of analysts, no changes to monetary policy parameters are expected. At the start of the year, the US dollar remains under heavy, yet fundamentally justified market pressure.
And now it's time for GBPUSD. Let's discuss it with Paulo Greco.
The average volatility of the GBPUSD pair over the last 5 trading days is 100 pips. For the pound-dollar pair, this value is considered as moderate. On Monday, January 26, we expect movement within the range limited by the levels of 1.3542 and 37.42. The upper linear regression channel is directed upward, indicating a trend recovery. The CCI technical indicator has entered the oversold area 6 times over the past months and has formed numerous bullish divergences, which have consistently warned traders of a resumption of the upward trend. The GBPUSD pair is on track to resume the 2025 upward trend, and its long-term prospects have not changed. Donald Trump's policy continues to exert pressure on the US economy, so we do not expect the US currency to grow in 2026. Long positions with targets at 1.3672 and 37.33 remain relevant for the near term, while the price is above the moving average line. It's a sign line on a graphic. The price position below the moving average line allows to consider small shorts with the target of 1.3428 on purely technical grounds. From time to time, the American currency shows corrections, but for the trend growth, it needs global positive factors.
That's all for today. See you online soon.